to allow us to serve our customers. Thank you.
Thank you, Mr. Covert. About 13 minutes left for the panel. Ms. Stewart.
Thank you, Mr. Chairman and members of the committee and Mr. Chairman. My name is Carol Stewart, Senior Vice President of Government Affairs for Advance America, a non-bank provider of consumer financial services, including cash advances. We have over 260 locations in the state of California and employ over 750 people. The CFPB and its supporters have failed to address the most critical question. If the rules are implemented as currently proposed, what happens when a consumer with an urgent financial need walks into a payday lending center and can't get the credit they need when they need it? Whether they're dealing with medical expenses, car repairs, or an unexpected cash shortfall before their next paycheck, consumers cannot predict the financial challenges they may encounter in a year, especially in our current economy. The Federal Reserve's report on economic well-being of U.S. households found that 52% of the respondents could not cover a hypothetical emergency expense of $400. Taking away their ability to borrow, as the proposed rules would effectively do, doesn't erase the need for credit or erase the challenges our customers face. Rather, the arbitrary limits on access to credit will push borrowers to alternatives that are either more expensive or have fewer consumer protections. In fact, in California, there really is no legal viable option for consumers who want to borrow under $2,500 other than a payday loan. The proposed rules do not create a level playing field among similar competing products as the Bureau said it would. Rather, the lockout periods and punitive underwriting standards amount to the CFPB picking winners and losers in the marketplace, creating new products and disregarding consumers' clear preferences in favor of the Bureau's own biased judgment, all without credible research, as you heard in prior testimony, to justify the proposals. Among the winners that the Bureau has handpicked would be more expensive bank alternatives, such as credit card and overdraft programs, which some borrowers may have the option to turn to in the absence of a payday loan. Despite unclear terms, hidden fees, and higher costs associated with the competing credit products, the government doesn't tell consumers they have to wait between credit card transactions or between uses of their overdraft protection program. There are no lockout periods for any of those programs proposed. As a result, these services have everything to gain from the rules that block customers from regular cash advance lenders. The other big winners would be illegal or unlicensed lenders who operate in the shadows and who inevitably prosper whenever regulated payday lending is restricted or banned. As California's Department of Business Oversight knows, these lenders are outside of the state's jurisdiction, and as one site is shut down, it will open quickly under another name, and consumers here will have no protection from them. And let's not forget who's pushing these proposals: well-heeled activists who have never had payday loans or had to use payday loans to make ends meet and think payday loan borrowers can't make informed financial decisions on their own. On the other side of the equation, the losers. At the top of the list are consumers who will lose an effective popular option for managing financial challenges. The proposed rules show that the Bureau still does not understand our customers, their needs, or the rational and informed decisions they make to use payday loans to manage their episodic financial challenges. Another loser, and I want to underline this, is a state like California, which has worked hard to develop laws and regulations that balance consumer protections with equitable access to credit. These states will lose ability to regulate payday loans as they see fit, no longer able to ensure that their residents have real credit options to choose from. Laws that have been crafted and debated over decades will be usurped by short-sighted and overbearing federal regulations. And finally, small businesses will lose. The proposed rules set requirements that no small operator can meet and that no other industry must adhere to. The rules would be an immediate death to small businesses and a slower death to larger operators. Customers choose cash advances because they're reliable, transparent, and readily accessible. The proposed rules essentially invent new products, completely like any product that any of the 35 states that regulate the market have in place. In a national poll conducted this year, almost 7 in 10 respondents from households that have used payday loans in the past agree they should be able to decide how often to take out a payday loan and not be limited by government over restrictions. In conclusion, I'd like to return to my original question. What happens when a consumer with an urgent financial need walks into a payday lending center and can't get the credit they need at the time that they need it? We know the answer to this. A Federal Reserve of New York staff study compared households in states where payday loans are available to states like Georgia and North Carolina, where short-term lending is effectively banned. The study found that consumers in Georgia and North Carolina, and I quote, bounced more checks, complained more about lenders and debt collectors, and have filed for Chapter 7 bankruptcy at a higher rate, closed quote. That's the inevitable effect of the CFPB rules. Bottom line, tens of millions of Americans choose and appreciate our products and services, yet Washington remains intent on limiting or eliminating those choices. Thank you.
Thank you, Ms. Stewart. Mr. Greaser, about 7 minutes.
Thank you. Good afternoon, Chairman Block, Chairman Dabadneh, and members of the committee. My name is Rob Greaser, and I'm a Senior Vice President of Government Affairs for Community Choice Financial Incorporated. Community Choice is a leading retailer of alternative financial services through a network of 550 branch locations operating in 15 states across the country. In California, we operate 160 branch locations and employ approximately 950 employees. In addition to our branch network, we also offer loans over the internet through a subsidiary called Cash Central of California, which is licensed under the Deferred Deposit Transaction Act and the consumer finance law here in California. We provide a variety of financial products and services, including short-term loans, medium-term loans, check cashing, prepaid cards, and other financial services that address the needs of our consumers. Specifically in California, we offer short-term loans up to $255 and installment loans above the $2,500 level. The current regulatory structure under the CFL does not provide us the ability to offer loans in between those two levels because it doesn't provide a profitable ability for us to lend. Prior to working at CCFI, I spent half my career as the primary regulator in the state of Ohio for the non-depository credit area, and that was within the Division of Financial Institutions under the Department of Commerce. My first job out of college was as a field examiner for this exact same group. And then after an initial period of 8 years, later in my career, I went back as the primary regulator in the consumer finance area. In my capacity as Deputy Superintendent for Consumer Finance, we regulated all of the financial lending statutes used by non-depository financial institutions operating in Ohio. As a former regulator, I am a strong proponent of state regulation of retail credit. Regulation of non-depository institutions at the state level has been in existence for approximately 100 years. This model has worked well and met the needs of the American consumer. While there is a need to update many state statutes to increase the regulated product choices offered to consumers in the marketplace, it is clear that state regulation still works today. The subject of our meeting today is the proposed rule concepts recently publicized by the Consumer Financial Protection Bureau. As we heard earlier, these administrative regulations focus on both closed-end and open-end credit products with specific requirements for loans with duration of under 45 days and loans with durations of in excess of 45 days. While the concepts present all sorts of problems for our industry and the financial marketplace, what is most troubling to me is the fact that if enacted, these new rules will severely reduce the availability of credit for the average middle-class American. The proposed rules will result in fewer choices in legitimate, regulated, short-term credit for consumers at a time when we should be working to improve and increase the regulated alternatives so consumers can make the best choice for their own personal situations. We serve a large and growing market of individuals who have limited or no access to traditional sources of consumer credit and financial services. A 2013 study conducted by the FDIC indicates that approximately 60 million adults in the U.S. are either unbanked or underbanked. Further limiting credit choices and the availability to this population, in my opinion, is not the direction we should be moving. We should not pretend that limiting legitimate choices of credit will somehow automatically end up helping consumers. Limiting legitimate choices does not instantly make the demand go away. Consumers will, without a doubt, continue to seek and find credit where they can. But without legitimate choices in the marketplace, the question is, where will they turn? As we all know, there are certainly many unregulated illegal services out there over the internet, overseas, and elsewhere, and they stand ready to fill any gap that exists in the marketplace. During my days as a young field examiner for the Ohio Division of Financial Institutions, there were thousands of companies running successful business loan programs throughout Ohio. Today, almost all of those companies no longer exist in the marketplace, and they've gone out of business. Overall, the availability of credit for middle-class Americans has been greatly reduced. And according to a recent Federal Reserve study out of New York, total consumer credit has declined by over $1.4 billion since the peak in the third quarter of 2008. This contraction in the supply of consumer credit has resulted in significant unmet demand for consumer loan products. If the CFPB is successful in implementing its rules, unmet demand is sure to continue to increase. It is important that states maintain their role as a primary regulator of consumer credit, and states should lead the way in developing more choices in legitimate credit for consumers, not further limiting the few choices available today. Instead of building barriers between consumers and credit choices, we should be building bridges to help consumers connect with real, legitimate financial solutions they clearly need. Thank you so much.
Thank you. Well, I want to thank this group. 24 minutes and 12 seconds. You guys had a time, did I tell you? I've got a few questions, and other members of the committee may have questions. If the proposed regulations in final form end up looking, the final regulations look similar to the proposed regulations, would any of you anticipate that your companies would stop doing business in California? If so, who? Who and why? Yeah.
Mr. Chairman, as mentioned earlier, my company participated in a study, and when we were back in Washington, D.C., we referenced that and we're providing it to the Bureau. The study concluded that there was 8 of us, 8 small lenders. We had 234 stores spread out amongst 15 states. My company has 25 stores. They're all located here in California. The average loan out of that study was around $255, so it's heavily weighted to California. 84% of the stores became unprofitable with putting the CFPB proposals into effect. That's what the study concluded. As a small business and representing other small businesses in our trade association, I don't see how you can stay open. You can't operate a business at a negative for that long. We have other products we offer, but we're not going to be able to provide specifically with California law too, we've already heard under 2,500, there's a dearth of lending going on other than at payday levels. So until that gets fixed, we're left without options.
Okay, so you guys would close down in California. Anyone else would close down in California?
You know, it's a slower death, as I mentioned in my testimony, for some of us that are bigger companies. But when you look at the fixed costs we have, the risks we take with uncollateralized loans, and the fact that a number of consumers who appreciate and use this product responsibly would be blocked out of this system with the overly restrictive underwriting criteria, I don't know how we sustain it for long, sustain a viable business model for long.
Mr. Chairman, and you asked us to make a lot of assumptions in your comment, and I appreciate that. I think Mr. Gwaltney and Ms. Stewart are right. At best case scenario, you know, we have 500 employees and 175 locations. We certainly don't have that. You know, can we operate some locations with some employees? Maybe, but we don't look like the company we look today, and there's a lot of unemployed people. Some of our employees are here in the audience today very interested in this, but we certainly have a lot of unemployed people at the very best case of your scenario.
One side comment. I don't know of a single company that operates in America that tells a customer who wants to come back and conduct business with that company that I am not able to do business with you. And after 3 loans, that's what we're going to have to tell our consumers when they walk in the door. We cannot do business with you. I can't even direct you in a place where you can get what you need. That, to me, is just really unusual.
Okay, and this is important information for the committee to have as we then reach out to CFPB with our comments. So do you disagree with the idea of any underwriting for your customers, or is some underwriting acceptable? Is any underwriting being done now? Who would like to respond?
I think we all do underwriting. I think part of the innovation and we always call it part of the competitive part of our companies are you make money. There are plenty of companies that fail. Part of the way we make money is we pick the right customers and we choose the right amount to lend to the right customers. We all have our own proprietary ways where we have to, absolutely we check, absolutely we do that. And you know, again, these are things that are being looked at by both our state and federal regulators. The CFPB has been in to see our proprietary system and see it work. They were very curious about how it worked and what it did. You know, we have a very fancy internal name for it, but that's not important. But absolutely, each and every customer for each and every product, we run through our own internal systems. Absolutely. There's certainly a level that's acceptable, yes.
Anyone else want to comment?
I agree, and I think Mr. Gwaltney made the comment in his testimony that we're not in the business to lose money, to have customers that can't pay us back. So we also have very sophisticated underwriting criteria that we apply to our consumers when they come in that tells us not only if they qualify for a loan, but how much up to the ceiling that a state allows that they qualify for.
So it's not the fact that there is underwriting in the CFPB proposal that you disagree with. It's how they propose to
It's
do
the overly restrictive underwriting.
Is there, and it's easy, not to say it's not true, but it's easy to say each have proprietary methods that then can't be shared, so we don't really know how you're underwriting. Is there any common underwriting that could be part of a regulation that, I won't ask you to answer that now, but to think about that and maybe get back to us, are there things that could be acceptable short of what CFPB is suggesting that you could all live with?
You know, again, if the CFPB would actually look at state models, what states like California, Michigan, Florida, South Carolina, Wisconsin, and Indiana, lots of states around the country have done, there are states that have put in underwriting criteria that we have been able to live with. And it's even the lesser of a specific amount, you know, a $500 loan amount or a percentage of that customer's monthly income. So absolutely, there are states that have looked at that. And if the Bureau would look at states and what they have done and real world data on how those states have balanced that access to credit with consumer protections, the answers are out there. The states have wrestled with this for almost 20 years and have come up with models that actually work, including your state.
Mr. Chairman, I think Mr. Gwaltney made the great point. I don't think that any of you as legislators, and I can't imagine anyone at the Bureau really means that for a $150,000 house, you're going to do the same amount of work that you're going to do for a $100 loan. I don't think anybody really thinks that makes sense in the business world. I mean, there's certainly things we can do, but we can't do the same amount of work that American Express does for a huge credit card or for a house or for a car. You just can't do that. That cost and that time alone makes the product unworkable.
Moving now to just the idea of capping the frequency with which people get loans. Mr. Grieser talked about being the only business that has to tell a customer after 3 times you can't come back. Is there any reasonable capping of loans? Can they come back 100 times in a year? I mean, what's reasonable? Or is there nothing reasonable?
Well, yeah, I mean, it's a good point. Mr. Chairman, one thing what we like to do and what all of our companies, the 4 of us that are sitting here do, a lot of states, it is state law. It's not state law in California, but we all abide by it anyway, is we offer an off-ramp for our customers if they want to. If they want to get out after a certain number of loans, we offer them a free extended payment plan. No interest, no fees, no added cost. They break it up and they get 4 of their next pay periods to pay it off, and they're done and they're out of the product. And there is no financial product in America or in the world that I know of that will do that. Ask American Express to do that for you next time on your bill and see what they say. They're not going to do it. So the answer to your question, though, Mr. Chairman, there are states that have tried to put limits on the number of loans. The problem is the average customer gets paid 26 times a year, every 2 weeks. If you tell them they can't take out any more than 5 a year, and in June something happens, their demand for money, their need for credit doesn't go away just because we set an arbitrary limit. They're going to get the money, Mr. Chairman, Mr. Vice Chairman. They're going to find a way, and we've already discussed, you've heard from both sides of the aisle today, that there are other ways for people to get the money if they need it. So when you set that arbitrary limit, I get where you're going, but people are still going to get that money and still going to have the demand.
Okay, thank you. Senator Morrell.
Thank you. Hey, I got a couple of quick questions. What is, the folks up here before weren't sure what the default rate is. What's the average default rate in your industry, in the payday loans? And just
Senator, if you look at the Department of Business Oversight's
Yeah.
numbers, the most recent ones we have from are 2013, and it shows 2.8% of the amount lent is the ultimate default rate. That's what's charged off.
Okay. Second question, whoever would like to answer this. I want to get back to the underwriting criteria because I think that's important, and I know you can't do, $150,000 home type of underwriting. But does everybody use debt to income, the ability to repay the loan, as part of your? You do.
A lot of states, Senator, use a gross monthly income test. A lot of state laws have that in there. And I know that's something that the Bureau has talked about, an income test along with or instead of a debt test. But yeah, all of that is, both of those are factors we look at.
You go, okay, because that seems to keep the biggest factor in my mind, to make sure they have the ability to repay. Go ahead.
Yes, Senator, a lot of companies that I'm aware of will look at, they come up with their own internal methods as we discussed, but they're looking for a residual amount of income to make sure that the customer can pay back. And that's why we cited earlier that the loss rates are really, really low because the customers, quite frankly, the customers are just looking for liquidity. And we're providing that. We're making sure that we give them the money that they need and they can pay back. And like I said, I want to cite the complaint reports, 510 in California. And there was over 12 million transactions. I mean, so I'm kind of perplexed when I hear stories about customers that are, I've heard debt trap. I've heard, they're drowning, and I'm not making light of some people that have had problems, and I think we need to look at solutions to solve those. But to paint a wide brush that everybody that gets involved and asks for a payday loan does not have the ability to pay it back I think is incorrect.
Hey, one statement, then one question. And this is just my observation since Dodd-Frank. I was speaking, I had the mortgage lenders were in town one day, and I went to one of their breakfasts, and they said that since Dodd-Frank, with all the regulations, 82% of small lenders and people in the mortgage business for homes, mortgages have gotten out of the business since then. That's incredible. You have payday lenders on this side. You've got your banks, your institutional lenders who write Fannie Mae, Freddie Mac. But do you guys recall, it wasn't that long ago, you had lenders in between that loaned their private money by the name of Abco, Beneficial. They ran out of business. I wonder, we're losing the ability, it looks like you guys could be on the line here. The Beneficials of the world had a great niche market. Those people couldn't qualify for the banks, and then they didn't need payday loans, and they were, they were wonderful for that niche market. And I just see so many of these financing things going away, and I was just reading the Wall Street Journal the other day talking about how Europe hardly has any ability to be able to loan money, where the money is drying up. So I'm just curious, what's your opinion, whoever would like to answer that, what is the problem here, why so many things are going away, and then at the end of the day, who's going to be left with the ability to actually loan money?
Chairman and Senator, in my testimony, that's who I was referring to, because as a field examiner, there were literally, right out of college, there were literally thousands of consumer finance companies that existed in the marketplace. And what has happened is that the rates and their ability to increase the amount of money that they make on these loans has never been changed. not been changed in 30-some years, where the cost of running that physical location has increased every year to the salaries that you pay, to the rents that you pay, to the utilities that you have to pay, computer systems and everything, and they could no longer compete in the marketplace. So they have gone out of business, except for very few.
Let's let Ms. Stewart respond to
And
that.
frankly, just to piggyback on that, the reason that you hear these horror stories, and we heard some from the group before us about people that have 2 or 3 or 4 or 7 of these loans out at a time, is that they don't have the credit option to meet the $2,000 or $1,500 demand that's in place, because those options don't exist in this state. So if there was a way to fill that gap with a credit option that was sustainable and could be offered by private companies, you wouldn't see people having lots of tiny loans out trying to piece together enough to get the actual amount that they need to borrow at any given time.
And Senator, I think I feel like we're almost skipping ahead, but Ms. Stewart's right. What you'll see in other states have different levels of regulation, but other states have different options. There are states out there that have more loan options out there, and some customers need $200 for 10 days. Some customers need $1,200 for 6 months. They all coexist together, and we service all of that, but some customers need different products. That is our problem in California, is we don't quite have the right product mix, and that drives a lot of these questions and a lot of these comments.
And as you say, we will be getting to the slightly larger, longer-term loans at the next panel. Any further questions?
And our company, as a business plan, is trying to fill that vacated marketplace. And we feel there's a lot of demand there. We also want to provide the customer a pathway back to the standardized marketplace, because those that use the short-term loan universally have bruised credit ratings. And what we would like to do is to have them perform successfully in that market, move them up a little higher, lend them a little more money, give them more time to repay, and decrease the cost, and then as they perform there, we can report that transaction to a credit bureau and move them on their way back to a standardized marketplace.
Okay.
Thank you very much.
Thank you, Senator Morell. Vice Chair Vidak, just one quick follow-up. You'd mentioned a couple times the 510 complaints or whatever. How do you inform borrowers about the complaint process?
Mr. Chairman, in the state of California, I think the law works really well in this regard, because every time a customer comes in, every lender must hand out the 1-800 number to the Department of Business Oversight along with the contract. The numbers I was quoting are actually, we don't have the exact numbers. Last time I heard from the department, it was roughly about 60 complaints in 1 year's time. The numbers I was citing are available on the CFPB's website. So those consumers can go online, or they can call in and lodge a complaint that way. And then in addition, most of the members of our trade association will have customer service hotlines posted in their lobbies as well, and we'll field complaints that way as well.
Okay, so the number you mentioned, these are complaints to a government agency, or including complaints to your?
They're to the federal government agency that's tracking the complaints.
Okay, thank you. With that, I will thank and excuse this panel